let's move on a little bit and talk about some of the investment approaches that are used out in the marketplace. Because this, from an investor level, I want to keep this pretty simple, not too complex, because most people don't really understand the different investment options that are out there. But there are obviously two, and most probably three, I guess. And that's one, they call it the passive approach, which is obviously you're buying the market, and you've got the active, which is more, I guess, professional management. And then I guess you can blend the two. You can do a bit of both. So you have to just at a high level sort of, I guess, explain the differences between those two approaches.
It's another area where there's been an inordinate amount of industry navel-gazing and for very little real beneficial outcome for end investors in a lot of sense in terms of the debate. Active versus passive is generally considered within an asset class context. So let's use shares as our example here.
Yep.
In Australia, we have... Yep. So the Australian equity market, which is generally tracked by an index, the All Ords is kind of the popular one that we all grew up with. But from a professional portfolio management point of view, we talk about the S&P Standard & Poor's ASX 200 index.
Yeah.
And so that's the 200 largest companies in Australia. In America, it's the S&P 500, the 500 largest companies. And it's what's called a market capitalization weighted index, which is just a complicated way of saying the bigger the company, the bigger the weight in the index. So interestingly, in Australia...
Really just it's just the top companies in that
ranked
area.
by size. Yep, largest down to, in that case, 200, in America 500, and there's a whole bunch of other indexes there as well. And so Jack Bogle, who was the guy who started Vanguard, used to talk about, don't try and pick the needle in the haystack, just buy the haystack.
Yeah.
And what we do, and the way we forecast returns, that income, earnings growth and valuation piece works really well in a well-diversified portfolio, works really well at a well-diversified asset class, country, sector, region, but not so much on an individual company, because they can have wild swings if they get something right or wrong, or make an acquisition, or management leaves, or those sorts of things. So the vast bulk of the industry makes the promise to their investors that because I've got the smartest analysts and the best models and the best access to management, that I'm going to be able to pick a different combination than the ASX 200 index and beat that benchmark and deliver outperformance to the broad Aussie equities market. There is reams and reams of research that says that's really, really hard to do. There's some great detail, which if anyone does want to sort of do a little bit more deeper dive into that, I'd be very happy to pass on. But at the average Aussie active stock picking fund manager doesn't beat the ASX 200 consistently over time. Yeah. I don't think I can do it. I have tried to do it in the past with no success. Hence, we don't try and do it anymore. As an investment committee, we spend our time deliberating, do I want to be in banks versus miners, Aussie versus offshore, risky stuff versus defensive stuff, not is ANZ going to do better than NAB or is BHP going to do better than Rio. There's been a huge groundswell of support for these passive instruments, ETFs, index funds, those sorts of things. We're north of 6 trillion-ish in US dollar assets globally now. And I saw an interesting figure the other day. From a US point of view alone, investors have saved $350 billion US in fees by being in lower cost. And that's straight on their bottom line. Yeah. Straight on their bottom line, you know. So on a long-term basis, again, the vast bulk of the variability in portfolio outcomes will not be based on stock picking. It'll be based on asset allocation, country, region, sector as well. It's been a fascinating debate to be a part of to some extent from an Australian point of view. And, you know, we can talk about the sort of behavioural biases and context here as well. Those who tend to be most sceptical about the efficacy of ETFs and index funds as a portfolio construction tool are not surprisingly those who've got the most to lose by, you know, the kind of emperor has no clothes moment about you guys are charging high fees and not really delivering anything, or you're delivering less than index returns. So we use these building blocks from, in simple terms, from an Australian equities market point of view. I kind of think of it in 6 boxes: banks, miners, and everything else. Large companies, medium ones, and small ones. And I can run a forecast for those. I run a whole bunch more as well. But if I can manipulate exposures and lean into stuff that looks cheap versus leaning away from stuff that looks expensive and potentially out of the way altogether, then that's going to be an efficient portfolio outcome for your clients. There's really no such thing as a pure passive portfolio. And so it's a bit of a ghost of a benchmark. Everyone is active. I was giving a presentation at a Bloomberg event earlier in the year, and this whole active passive came up in an industry context. And I was pinned as the passive guy because I build portfolios using ETFs. But I went, well, I've got no US in my international equities. I'm overweight Aussie. Within that, I'm overweight banks. I've moved from mediums to small. Like, how am I passive? Passive against what? So really for us, it boils down to being honest about, I don't think I can pick stocks and beat the index. What we think we can add some value in is taking a longer term view, running those forecasts and then building portfolios using these cheap, transparent, tax efficient building blocks.
Yeah, and I guess a good lesson there is the good old Warren Buffett of the world that everyone knows. He's put out there as the world's best investor, who's been
one off for sure, yeah.
Who's been very active in his approach, but he's a big company. He can buy whole companies, but even he has said when he's dead that his estate is to be put in an index fund. So that if he's the world, deemed to be one of the world's best investors, then why wouldn't you just take his advice? He knows how hard it is to pick, and he's got the advantage where he can pick whole companies and take the whole lot.
That's it. And
whatever he needs to.
I mean, where he does that is either in private holdings. I mean, because he's of a size now, he hasn't actually outperformed the S&P 500 for some time. And so we see, again, around market cycles about every sort of 8 to 10 years, Warren's a dinosaur and he doesn't know what he's doing and the world's moved on and left him behind. Yeah. And I've been reading quite a bit of that just in the last 6 months or so as well. But he also doesn't play the same game as us, as you rightly say. He got his start by owning an insurance company and had this free pile of cash to invest for the long term and go and buy whole companies and hold them forever. And there is absolutely wisdom in what he writes about in his annual letter, but he doesn't play the same game as certainly mum and dad investors or almost all institutional investors either. So it's very much a case with Warren of do what he says, not try and do what he does.
Yeah, and I think that, if this guy's been highly successful at it for, what is he? Is he in his 90s now?
Not quite. Charlie Munger's in his 90s. I think Warren still starts with an 8.
Okay. And he started, about the age of 15 or something, I think, when he started.
Yeah.
So he's been at it for a long time. So I guess we've sort of covered a fair bit on there, but if an investor was sort of looking at what approaches, I guess, is best for them, how would they sort of go about that? Just some insights into things that they perhaps need to consider. I know we have an approach that we use, but just for the general person out there sitting there going, well, hang on, there's all these options. There's a million different ways of going about it. What's actually going to be right for me? Because I know we say to clients, it's not a one size fits all. So, what would your advice be for investors out there trying to choose what type of approach is going to be right for
them? It's almost an impossible question to answer, as you say. There is no
challenge.
I can remember when I started accumulating some savings and buying some individual shares as a teenager. It was a completely different world. There were no index funds, there were no ETFs. I'm old enough to remember, looking up the share price in the paper the next day.
Most of them, I remember back when I was young, there was they'd issued Commonwealth Bank shares. Rarely
absolutely. Telstra floats, the demutualizations, the privatizations of former state-owned assets. Look, if you do have a genuine interest, there's some obviously foundational reading topics to educate yourself. I've often had this conversation with children of investors, who have shown an interest in where do I start. And it's find something you're interested in.
Yeah.
Do some research. Even within that, there'll be areas of specialization that won't immediately be apparent. Understand your capabilities. And even in some conversations I've had with advisors who choose to outsource the portfolio management to us, it's not because they can't do it, it's because their time is better spent understanding and building relationships with their clients and being a counsellor and doing all the other bits other than the portfolio management stuff. So I'm kind of prevaricating a little bit because I'm not sure there is a simple answer to your question.
Yeah, I guess if I can cut in there, John, I know I sort of challenged you on that one, but if you look at all the research out there, and I look at research all the time, whether it's from investors or from an advisor perspective, but the value add from an advisor on the performance of a portfolio is actually extremely small. I think the value add from a behavioural perspective is something in the range of 1.5 to, depending on which report you look at, 2.5% on the.
I've seen up to 2.5, 3. Yeah, absolutely. And that's the counsellor role again. And I've many times I've stood up in front when we're able to do it face to face, stood up and said, Glenn, as a good counsellor who stops you, pardon me, doing silly things like getting scared and selling at the bottom and piling in at the top, will add far more alpha, we call it in the industry, far more outperformance to a long-term benchmark than I will as a portfolio manager shifting assets between banks and mine as an Aussie and international. So we're not swinging for the fences, as the Americans say. We're not trying to shoot the lights out. We're trying to have a steady, consistent, transparent, understandable approach. And if we do that and we get clients who are on board with that, then we'll get a good long-term portfolio outcome, whether it's GFCs, coronaviruses, exuberant times as well. We'll be hit with all of them, and God knows what the next one will be. But the approach has worked for decades. It will continue to work no matter what gets thrown at it if we stay the course, and we will do that if we all understand what it is we're trying to achieve together.
Yeah, and I think it's one way that we look at it as well is protecting clients from the blind side. Look, we know there's stuff that's going to pop up. We don't know when that's going to happen, but when it does, we know what we need to do. And I think that's the thing for a lot of people that go on their own. They've got no idea. They've never dealt with half of these issues. It's a complex, particularly retirement planning. It's complex. It's never simple. Doesn't matter how much money you got. There's a lot of things at play. And we say this quite a bit to clients. Even when they walk out with a plan, that plan is redundant the minute they walk out the door. It's about having an appropriate process in place to be able to realise we've got we're either off course or on course, and we've got to make these small micro changes to get back to where you need to go.
Absolutely. And look, there's huge parts of the financial planning process that I've completely forgotten in the 10 plus years since I've done it. Tax efficiency, structuring, protection strategies, all superannuation, down to Centrelink maximisation in some cases as well. So we're in one little sort of silo of the portfolio management piece, but there's enormous opportunities for value add across the broader advice spectrum rather than just the investment portfolio piece.
Yeah, for sure.